Welcome to Facts, Figures, and Fallacies from the Frontline Podcast with Mitzi E. Sullivan, CPA.
Welcome to the podcast for Mitzi E. Sullivan, CPA, PLLC. I'm Jessica, and we're going to chat with you about active or passive income. That's the question. So before we get started, though, be sure to check out the links in the description in this video to join us on Facebook, LinkedIn, and Twitter, and sign up for our weekly newsletter to make sure you keep up with all the changing tax laws and regulations as they are released, and follow our discussions of tax and business strategies. Please leave a comment and ask questions. Let us know what you liked to identify topics that you'd like to see in future podcasts. And with that, I'm going to turn it over to Nick, who's going to start talking to us about active and passive income.
All right. So what is active income? What is passive income? Does that sound like gibberish to you, Marie?
Well, maybe in my 20s, 30s, but I've learned as I get older, the more passive income I have, the easier my life is. Is that correct?
That's correct.
We want to aim towards passive. Is that the right answer?
Well, maybe.
Okay.
So I'll say that the answer depends on your individual situation. And
Yes.
so that's what we'll kind of dive into. I wanted to start off by describing the difference and kind of talking about, what is the difference, what are the differences and what are the different types of income.
Mm-hmm.
And so income actually go into three different buckets. There's active income, there's passive income, and then there's portfolio income. Mm-hmm. And depending on what type of income you're receiving, there are different tax consequences. So active income, that's your most common income. That's wages from a job. If you're a business owner where you're actively materially participating, that's going to be active income. And so what that means is you're going to be taxed on that income at the ordinary rates, and you're also going to have to pay that Social Security and Medicare tax, which is going to be withheld out of your paycheck. If you're an employee, you're going to split that 50-50 with your employer. There's no getting around it. If you're a business owner, you're paying the Social Security and Medicare the full 15.3% yourself, and that's referred to as self-employment tax. And so that's your active income. Your passive income is going to be income where you're not materially participating in the day-to-day activities. So that'd be, for example, if you're an investor in a business, like an equity investor, where you've put some money into something and you're just getting, the benefits, the passive income to yourself. Rental income is a good example of that. And then so with passive income, I'll mention you'd pay the ordinary tax rate. However, you don't have to pay that self-employment tax on that income. The only other potential tax you would pay on passive income is what's called net investment income tax. Mm-hmm. That would come into play if, for example, if you're married filing jointly, if your adjusted gross income is above $250,000, then you actually have to pay a 3.8% tax on passive income called net investment income tax, and that's on your investment income. Now, the third bucket of income is portfolio income. That's going to be your capital gains, qualified dividends. Oftentimes for portfolio income, that's coming from some type of investment account. And long-term capital gains or qualified dividends, for example, those are actually taxed at a preferential tax rate. So it's going to be generally a lot lower than your ordinary tax rate would be.
Right, unless you withdraw. And then as far as portfolio, right, Mitzi? Like it stays low as long as you don't withdraw your portfolio income. Is that correct?
So I think you're confusing portfolio income with your retirement income. Is that what you're talking about?
Well, just any type of investment.
Okay. Mm-hmm. So, and maybe you're talking about whether or not you have a capital gain. Okay. So when that money is invested, you're right. The market will go up, the market will go down. Mm-hmm. As long as you don't sell that stock or a mutual fund, whatever you're holding in your investment account, as long as you don't sell it, you don't realize a gain, then you're right. There's no tax on that.
Got it. And so what are some real examples of passive income? You said rentals? Is that like Airbnb or a home that you rent out to someone else, or what are some, Nick, what are some examples of passive income?
Yeah, so an example, for example, rental income, someone who has their main job as an employee, let's say, is working as an accountant. But then on the side, they have a rental house that they rent on Airbnb. And so if that's let's say it's a long-term rental, you're just collecting rent each month, that's going to be passive income generally, because you're not materially, you're not a real estate professional, you're not materially participating in that business. So that's going to be passive income to you. Or a better example would be if you are an investing partner in a partnership. So for example, let's say there is a new apartment complex and you invest money into this partnership. Let's say you're a 10% partner. Well, you're not doing any of the day-to-day work. The other partners are doing that day-to-day work, and you're just kind of receiving that income, that return on investment. That would be passive income to you because you're not actively participating and actively making managerial decisions for that business.
Yeah, that makes sense.
So I'm going to go back to active income and just mention, a lot of people, when they hear this, they think, well, I don't want active income because, I don't want to pay that Social Security and Medicare, right? There's no getting around it. If you're an employee somewhere, that's getting withheld on your paycheck, and it's going to be 15.3% shared 50-50 employee with employer. So if you're a business owner and you work for yourself, when you file your tax return, you're going to have to not only pay your ordinary income tax, but you're going to have to pay that 15.3% self-employment tax. So that is one thing that does catch people off guard if they start working for themselves and they're not familiar with how this all works. But that's obviously a big tax that you're going to have to be ready for. With passive income, generally it's just going to be your ordinary tax rate, and you're not going to have to pay that Social Security and Medicare. You might have to pay that 3.8% net investment income tax that I mentioned. And then with the portfolio income, it's generally like, let's use long-term capital gains as an example. If you have you have a normal job, you're an investor in this apartment complex, so you have active income, you have passive income, and then you also have an investment account where inside that account you bought some stock in a company, and 2 years go by and you sell that stock and you have a gain of $50,000. Well, you realized a $50,000 gain, you're going to recognize it on your tax return because you sold it and you have that $50,000 gain. That, because it's a long-term gain, is taxed at either 0%, 15%, or 20%. So 20% would be the max generally that's going to be taxed at. So that's kind of how that works.
And those percentages are based on your income?
It is based on your income.
Right. Okay.
So for someone who maybe doesn't have any other income, or they're, in a very, very low income bracket, they may not even have to pay tax on the long-term capital gain.
Oh, I didn't know that.
Right.
Okay.
Now I kind of wanted to discuss the different tests that the IRS has that allow you to qualify as materially participating in an LLC or in an investment.
Yeah.
So
I'd like to know
Nick,
what that is.
before you get into that, let's just make the point where when you go to do your tax planning, you want to make sure that if you're going to have $100,000 in active income and it's possible to qualify these losses as active losses, and you can't flip-flop back and forth, active this year, passive this year. But what Nick's leading into is if you need those losses to be active because you have so much active income, then there are some qualifications that you need to meet to get active. Sometimes you may need some passive losses to offset some passive income. So then you structure in such a way that you are passive. And as I said, you can't flip back and forth, for just for tax purposes.
Yeah.
But you can structure your activity so that it creates the type of income that you need.
The IRS has 7 rules that allow you to qualify as having material participation in a business. And so these 7 rules, we're going to link those below so that you can really read those. The key takeaway from these 7 rules are that if you want to have that material participation, then you need to meet one of these 7 tests. If you don't want material participation and you really want to be passive, you need to make sure that you don't meet any of these tests. And I'm going to kind of summarize a couple of them. You know, the biggest and generally the most referred to is going to be that you materially participated in the activity for more than 500 hours in a year. And so really that means that you're involved in managerial decisions, day-to-day operating activities for more than 500 hours in a year. Now let's say another one of these tests and another example would be that, maybe it doesn't take that much work to run this business. Ultimately, like we mentioned at the beginning, it differs for each individual. And so, we can't tell you that passive income is better or that active income is better. It really is going to depend on your specific situation. And so that's just something that you want to be aware of and something that you want to think about if you're going to make, an investment in a partnership or, help start a business with a friend or something like that. These are just things you want to be thinking about from the very beginning when you're setting up that operating agreement.
And as a small business, I like having the team so I don't have to make these decisions alone.
Right.
Just sitting there wondering, am I active? Am I passive? Which one's better? And then, poor Nick, all of you keeping up with these tax laws. Thank you so much. I really appreciate that. And so it's nice to know or to plan if you are starting your own business, make sure you have multiple professionals with their eyes and ears on it. Don't you agree, Mitzi?
Yes.
So you're not just trying to navigate all
Yes.
these
So a
alone.
lot of times what we see is somebody, you asked about the Airbnb business. So let's say I start up an Airbnb business and I think, I'm going to have all these great losses to write off. It's going to offset my CPA income. That's going to be great. Well, it depends. Am I active? Am I passive? And so one of the rules that Nick was talking about is, are you putting in more work than any other individual? Well, if I hire, let's say I'm self-managing my Airbnb, but I hire a cleaning professional. Well, chances are my cleaner is going to spend more time cleaning that house than I do managing the house. And in that case, if I don't have my 500 hours, then I'm passive in that activity and not active. So just things to consider.
Okay.
And it really takes a team. If you're going to do, strategic business planning and strategic tax planning, you are not going to do that, and we are not going to do that all by ourselves.
Yes. And that's one benefit I see. I love getting in that room with the screen, looking at the numbers, analyzing it as a team.
Yes.
So you can make plans to save money, make more money.
And make better decisions. So
Definitely. Well, that about wraps up this podcast episode. If you have any questions, please do reach out. You can leave a comment. You can visit our website, contact us via phone, set up an appointment. We'd be happy to dive further and help answer any questions. So thanks so much for listening, and we will see you next time.
Thank you for tuning in to today's episode, and let us know if you have any questions about today's topic. We'll see you next time.